Hello dear students, good morning. Today we are going to be discuss the whole chapter notes of dividend policy. You will understand so many things. Please be with me. In dividend policy chapter, what you will learn after watching this full video, it is important to know by you. So I'm going to be discussing this video. The first thing is meaning and concepts of dividend policy. We are going to be discuss stable dividend policy, constant dividend policy, residual dividend policy. After that, we'll discuss importance of dividend policy decisions. So it means if dividend policy decisions are important in a firm or in a company or for the investor. This whole scenario we'll discuss under this heading. We'll discuss also here the dividend payment procedure. It means how, when, and what amount they are paying to their investors. After that, the last discussion in the slide is stock dividend. Why companies are issuing stock? Is it necessary? So many questions are coming in our mind during the dividend policy. We'll answer in this slide. And the last, it is most important, stock split. Mostly companies are doing this during the years. What is stock split? Why companies are splitting their stock? And is there reverse stock split is also there? So this whole we'll discuss under this video. Being with me, you will learn many things. Meaning and concept. Dividend policy is concerned with the financial policies regarding paying cash dividend in the present or paying an increased dividend at the later stage. Whether to issue dividend and what amount is determined mainly based on the firm's appropriated profit, or we can say that excess profit, and influenced by the company's long-term earning power. When cash surplus exists and it is not needed by the firm, then management is expected to pay out some or of those surplus earnings in the form of cash dividend or to repurchase the company's stock through the share buyback program and so on. So many practices are there company can do if company has extra excess money. Dividend policy is the policy which a company uses to structure its dividend payout to shareholder. Most of the firms view a dividend policy as an integral part of the corporate strategy. Management must decide on the dividend amount, timing, and various other factors that influence dividend payment. There are many dividend policies such as stable dividend policies. A stable dividend policy is the easiest and the most common used. The goal of the policy is steady and predictable dividend payout each year, which is what most investors seeks. Whether earnings are up or down, investors receive a fixed amount as a dividend. The goal is to align the dividend policy with the long-term growth of the company rather than the quarterly earning volatile. Constant dividend policy. Under the constant dividend policy, a company pay a fixed percentage of earning as a dividend every year. So here they are focusing to fixed percentage of dividend. In this way, investors experience the full volatility of company's earning. If earnings are up, investors get a high amount of dividend. If earnings are down, investors may receive less dividend or may not receive any dividend. The primary drawback of the stable dividend policy is that investor may not see a dividend increase in boom years. Another drawback to the method is the volatility of the earnings and dividends. It is difficult to plan financially when dividend income is high volatile. Residual dividend policy. According to the residual dividend policy, dividend will be distributed only if earning remains after financing equity need in organization. It means residual policy is asking to look first your company's requirement. Once you are fulfilling the company's requirement and extra or excess profit is balanced, then only think about the dividend. This policy is believed to reduce the flotation cost, because again, if you are going to be issue new share in the market, it means you are going to be enhance or increase your cost. But if you are retaining your own profit, it means you are not going to be expense any excess expenses or bearing any extra cost. In this regard, the organization should issue high number of equity stock to receive the required finance for capital investment purpose, because new issue equity capital is more expensive than the capital raised by retained earning due to the cost as we mentioned before. Importance of dividend policy decisions. There are many reasons affecting the dividend policies, such as some reasons I brought here for your understanding purpose. These are important. Financing need. One of the most important reasons that all organizations do not have equal access into the capital market, or the cost of collection fund from the market is high. So the organization with limited resources only consider internal resources, and internal resources is based only on the earnings, and whatever earnings you are retaining in your organization, it is retained earning. So it means financing need is depend upon the dividend policy. This is the first important. Second, liquidity need. Dividend decision is based on the liquidity need of managing organization whether to pay or retain. For both reasons, organization need adequate level of cash. Legal restrictions. An organization may not to pay dividend if liabilities are more than assets, the amount of dividend excess the profit, etc. Ownership control. For the purpose of control on the vote percentage, owners do not want to issue new stock into the market. Mostly small or some of large organization would be preferred to use of debt capital or retain earning only when we are need additional fund from the market. Earnings. Dividend decisions are also based on organizations' earning. If earnings are constant, then mostly organizations are paying large amount of dividend. But if earnings are not constant, then they are keeping large amount of retained earning for the addressing future need of investment. Dividend payment procedure. Generally, dividend paid either annually, semi-annually, or quarterly. But any payment mode, there is a set pattern of dividend payment. It is showing in the following step. Number one, declaration date, the date in which the board of directors announce the future dividend. Date of record, in this the date when the security or means stock transfer book are closed. On this date, the investor who owns the security or stock are entitled to get the dividend. Ex-dividend date. 2 days before the date of record, the brokerage firms are terminated the right of ownership. Last, payment date. Dividend checks are transferred to the security owners or stock owners. Those are keeping the share with you. So in overall, we can say that there is a 4 steps when we are paying the dividend. First, declaration date. Second, recorded date. Third, ex dividend date. And fourth is finally our payment date when money is transferred in the investor's account. Stock dividend and stock split. This is also a very interesting part of the dividend policy, and it is very interesting to know that what is and why stock dividend and stock split is required. So let us be with me. Hope you will be understanding in an easy way. stock dividend. This is a payment to shareholders that is made in stock rather than in cash. For example, when a firm declares a 10% stock dividend, it means that every stockholders will receive an additional 10 shares out of 100 own share. So in place of cash payment, companies are preferring to give number of stock split. As per the market need, the board of directors are responsible to divide the firm's outstanding stock into the multiple stock. For example, if a firm which has 100 issued shares priced at $50 per share has a market capitalization of $5,000, or we can say that 100 multiplied by $50. If the company is split it in a stock 5:1, there are now 500 shares of the stock and each share hold 5 out of 1 share. The price of each share is $5,000 divided by 500, it means $100. So it means the value of share was 15, now the value of share is 10. So that one share is divided in 5 shares. This is known as stock split. Actually, the companies are doing this work to easy sale and purchase for the investors in the market, because we know that over the counter table market, the secondary shareholders are purchasing shares backside in the market, not by the company directly. So if the share price is very high, it is difficult to purchase over here, because high prices contain high volatility, high risk. Less price, less volatility and less risk. So that's why stock split is important by the board of director or by the companies. Even sometime reverse stock split action is also required by a firm. This is the opposite action. In this firms reduce the number of stocks. Sometimes company don't want more sale purchase in the market, so strategically they are taking decision, but very few times they are taking decisions to merge some shares into one shares, or we can say the same opposite example, that 5 shares for $10 they can merge together in one share for $50. Thank you very much for watching this video. I hope you understand this video, and along with this video we are having dividend model that I explained in my other videos. So if you want to go for the models like approach, Gordon model, Walter model, you will get my separate videos along with the cases, and the cases will give you a easy direction how to solve the problems in your class, in your exams, or asking by your teacher. So being with me, you will get very fantastic videos, but don't forget to subscribe and like my channel. Thank you very much.